Both of those products are growing, frankly, faster than expected. Delivered an extremely strong second quarter. We're anticipating a strong third quarter as well for both products.
Revenues come from Keytruda and Gardasil.
Yeah, so Keytruda and Gardasil probably represent
Hello, everybody. Welcome to the webinar. My name is Mark Shawson. I'll be starting this in about a minute or so. I'll let everybody get situated, and then we can get cracking. All right, Dwight, I'm ready to start. If you want to let, okay, I guess everybody's been let in.
Yeah, everybody. Well, those are who are here.
Okay. All right, I'm going to go and get started. So welcome to this 3-day live trade execution webinar series, subtitled How to Capitalize on Monster Moves in the Markets and Also Avoid the Market Traps. My name again is Mark Shawson, the pattern trader. This week, I'm going to talk about how I look exclusively at price trends, price patterns, price action to make determinations on buying and selling in the markets. You know, there is so many themes and sub-themes going on in the market. You know, how much inflation do we have? How much inflation do we have to knock back? What is the terminal rate? Where are Fed funds going? What is Powell going to do? How are the markets going to respond to do all of this? And, you know, if you think about all this, all you're going to do is get a headache. These kind of thought processes really have, you know, no bearing on trading. Trading is all about timing, about risk reward, and that's really it. Trading really comes down to where do I think the market is going and how much am I willing to bet on that trade and what is my outcome? And so these are the questions that you need to be asking yourself. If you're trying to sit in your chair and play amateur economist or, you know, see what the Fed chair is going to do, it really is not going to help you in trading. The markets are counterintuitive. The markets are a discounting mechanism. The markets are ahead of the moves. And then the markets sometimes hit these levels and then, you know, have huge flushes. You know, I think the market's going to go down huge, but last week we had back-to-back days where the market was up 2.5% each day. It was the first time that happened since April 2020. So it does you no good to kind of, you know, do these, you know, economic machinations. It's all about determining what your entry is, what your risk, what your reward is. And over the next couple of days, you know, I'm going to, you know, discuss exactly how you execute trades based on my 4-step trade execution methodology. So before I kind of get into it, you know, I'd like to show you what I'm doing. You know, I'm an active trader in the market. So I started the pattern trader about September 2015. It's going on almost 7 years now. I can't believe it's been that long. But I really started the pattern trader to give back. You know, I've learned so much over my decades of trading in the markets that I really just started it as a way to give back, teach people how to become independent, how to look at markets for themselves. But at the end of the day, as much as I love, you know, teaching and talking about the markets, I am at my very core a trader. I probably will trade till my last breath. I love the markets. I love, you know, the challenge of the markets, and I'm always doing something. I'm not really doing a whole lot these days. I'm in 2 little stocks. One is called Bumble, BMBL. It's a little $24 stock. And the other is Schlumberger. This is an oil service company. I'm in the stock, and I'm also in the options. So I bought these call options. A call option is a bet on the upside. It's a very leveraged bet. And I started when I saw the, you know, the price movement, the price patterns in Schlumberger a few weeks ago. I sent out an email to our members to buy Schlumberger at $36. You can see today close at $42. And I started buying these call options at 44 cents. And you can see right now they're trading at $1.35. So I'm making about 400% on my bet there. They were a little bit down today, but overall I made about 400%. But it doesn't make a difference. It's only when I sell it. Tomorrow these things could be cut in half for all I know. So I'll tell you why I did these things, and then I've got active trades in the currency markets. I'm very short the New Zealand dollar versus Canadian dollar trading pair, and then I'm long the British pound versus the New Zealand dollar. When I think about it, not very diversified. Both these trades are correlated to the New Zealand dollar, which I think is on balance probably the weakest currency on the board. And so I'm just looking at the merits of these two pairs. I've been long, short the New Zealand dollar, Canadian dollar since August 22nd. So almost 6 or 7 weeks now. So that seems crazy to most of you. Most of you are in and out of the markets 5 times a day, trying to nab 10 pips here, 7 pips there, 15 pips. I don't get into a Forex trade unless I can make 150 pips. So you can see, and if I'm in a good trade, I will just sit in that trade. I have been in this trade for 6 weeks now. In fact, if you've attended any of my webinars, you will have seen, me advocate shorting New Zealand dollar Canadian on the last several free webinars. And today we're sitting on the low of the last several months. So, here are the trades that I sent out to our members all the way back August 24th. I said, sell this thing at 80.25, the New Zealand dollar Canadian. I said, it's formed several bear patterns on the daily and weekly charts. I said, it's poised to break below the support line here. And all kinds of bad things are looking like. I said, I think it's worth jumping in at current levels. Patience should pay off being short this pair over the longer term. And that was 6-7 weeks ago. So here we are. It was at the 80 level back then. Now it's at 76, 400 points lower. And I'm still in the trade. And if I like a trade, I add to it. And so you can see I have added to that trade and currently short several pairs of New Zealand dollar Canadian. In fact, I've shorted it 3 times. One at 80.45, one at 80.40, one at 79.12, and now it's trading at 76.65. So I've got 300 to 400 pips on these positions, and I'm still holding. There's no reason for me to get out. A few weeks ago, I shorted gold at 1,800 and silver at $21, and they dropped out of the sky, and I made a whole bunch of dough. So these are just some of the trades that I've sent to our members over this is the dollar yen. I said buy dollar yen at 117, and today dollar yen's at 145. I said buy euro yen, and this was the outcome. So this is what I do. I only look at chart patterns. I don't, determine is the Fed going to give us a hard landing, a soft landing? Let me give you previews of coming attractions. It's going to be a hard landing. There's going to be a lot of pain, and this stock market is going a hell of a lot lower. And so, do I just throw that opinion out of the blue? No, it's basically, what the charts are telling me. To me, the charts tell me, what I need to know. The market is a discounting effect. So there are so many themes and sub-themes, and we're wondering, how things are going to work out. Well, the patterns, the trends, the chart patterns, tell us what is going on. And so what I have in front of you is the chart here of the S&P 500. This is one of the major stock indexes in the United States. And you can see that, markets are either in 5 phases, really. Most would say in 3 phases. So the market is usually going, let me just grab some, it's usually going higher, or it's going lower, or it's just doing nothing and trading in a trading range. Those are typically the 3 outcomes or expectations that most people, view the market or the prism. To my mind, I'd like to add 2 more. One is a market that has been going down, and then all of a sudden changes direction and goes the other way. Or you have a market that has been going higher, and then all of a sudden crashes out of the blue and goes lower. So these are the 5 trading conditions that we have in the market. That's it. That's all that can happen. So it's amazing how people lose their money when these are just the outcomes that the market can do. So I will trade all of these 5 conditions except this one. So to me, what I am looking to do in my trading is to take pieces of the middle out of broad moves in the market. So when the markets take a nice move, I just want to take a piece out of the middle of those. And that's my objective, whether it be 1 day, 3 days, 3 weeks, or 3 months, or in the case of the New Zealand Canadian, I might be in this thing for a year. I'm just looking to take pieces of big moves in the markets. I'm not looking to dart in and out like a nut, hunting for squirrels, darting in and out of, a tree. So in order to do that, I look at the markets on bigger time frames, monthly charts, weekly charts, or daily charts. I do look at smaller time frames, but when I do, it's usually because I'm losing. I'm usually trying to find a way to get out or figure out what's going on. And when you're confused, you really should just get out. The market should be effortless. You're either in a good trade or you're not. And so these are the 5 conditions I look for, and I look to just take a piece of the middle of moves. And so you can see that from the depth of the virus, the pandemic, when the central banks started doing helicopter money, just dropping money from the sky, all assets went higher. This was purely a function of free money, did not reflect any reality. Now reality is, coming back and kicking us in the behind. So during this thing, all you wanted to do was get in lockstep with that trend. But people always say, well, you really can't pick tops or bottoms. I really beg to differ, because I think that's really where I shine. That's really where I consider that as my strategic advantage. To me, when a market makes a top or a bottom, it doesn't just do that out of the blue and then drop out of the sky. Before it does so, it usually puts on a price pattern that we can recognize before it goes in the opposite direction. So there are several price patterns. I forgot to put that in. Let me see if I can find it really quick. I forgot to put the strategy worksheet in the, let me just do that now. I'm going to put that in the chat box right now. So here's a strategy worksheet with, some common patterns that I look at, and also the scientific basis. So it turns out when you see these patterns, they typically go in a certain direction after the pattern is formed, usually 100 days. So, typically when you see a double bottom, we've looked at 35,000 scientific studies, and it usually shows that a market will move higher off a double bottom for over 100 days. Now, that's not every day going up, but over a 100-day period, this market should on balance go higher. Conversely, when you have a double top, you will have a market that goes lower. So I simply look for these patterns, and then, I look for certain price action to back up what I'm seeing. So let me just kind of get rid of some of this distraction here. So after this thing started running up, the S&P, it started getting very complicated. And we started to see the appearance of certain conditions, which led me to say that this market was going to turn, and going to turn very badly. So these are just kind of the flavor of some of the emails that I sent out, since the beginning of the year, really, since January, since November of last year. I said the Fed is going to have to almost kill the patient in order to save it. Stock markets are likely to plummet. This was several weeks ago in August, and the markets have just done nothing but crash since then. This was where I said, I expect S&P companies' earnings to drastically decline. I foresee a massive decline in the major indexes and individual stocks. And this was back in September. But these emails go all the way back. I was telling our members to short FedEx at the market when FedEx is trading at about $215, and FedEx is just fell out of the sky. It's now trading at about $150. So how do I foresee all of these things? To me, again, it's just a matter of looking at what prices are telling us. And this is all that you need to look at. You don't need to rely on any forecasters or analysts or pundits on TV. Even the Fed, they've proven they do not know any more than any individual trader or forecasting firm. They have been profoundly terrible predicting inflation, then predicting it was transitory. And now these are the same guys that we're trying to help, get us out of the ship that they put us into. And I don't have a whole lot of confidence. So the patterns that I'm talking about, there's three major patterns that converge that tell us that this stock market really has nowhere to go but lower. Even though we're down 20-25% in the S&P for the year, I think we're probably only halfway there. And the next half is going to be really gruesome. A lot of people are going to get hurt. I think there's actually an even chance that we go down to 1800. But that's for another day. So to me, patterns equal trajectory. Once we see a pattern, we can then understand what the trajectory is going to be, because what we're looking at here is a top pattern. When the market runs to a peak, backs off, retests it, now we have what's called a double bottom, a double top. Sorry about that. We have these two peaks, and you basically now have this top. And when you go through the neckline, which is simply a line that is drawn through the pattern, it effectively confirms that the top you're looking at is game on. And that's what we're seeing playing out. Once the market has topped, with the word top in it, it can only do what? Go down over time. And that's what we're seeing. But, it's not been easy. And, there's just always these huge short covering rallies. This was up 25%. This was up like 15%. We're just treading water at this area here, and it's very possible you have another rally before it goes the other way. So it's kind of been a treacherous market, notwithstanding the fact that I know where it's going to go. The way it gets there is not easy. So you really have to understand your levels. You have to understand your risk. And, but notwithstanding the fact, you have to understand the cards you're holding, because what this market does is that it goes up, gets everybody, all lathered up that, we're going back to new highs, and then it makes a new low. Then it goes down, has a huge rally, everyone gets worked up, makes a new low. Then we have this huge, magnificent rally. Everybody on TV said the June lows were in. That's it. We're done. We're not going to see them again. But if you understand bear markets always go and make a new low. And that's what you're seeing here, is this kind of sawtooth, grind. If you look at the bear markets of the 1930s and the Depression, we had like 15 different rallies of over 15% on our way to being down 80%. So let that sink in. So every time this thing rallies, it feels like, whoa, now, reflexively, we've been so hypnotized. Since 2009, we've effectively been rewarded with buying the dips. Every time this thing comes down, you've been rewarded, because every time it makes a new high. So there's been this hypnotic programming that we think, wow, once there's been enough carnage in the market, now it's safe to come back in the water, and that's when you get detonated. And I think this is what's going to keep happening. That's what the nature of a bear market is. It just keeps making new lows, even though it looks like it's, all green lights. So we are at a significant support area here. So this is where it gets a little bit treacherous. You can't just say, okay, the market's going lower, let's hop aboard here, because you really don't know where your risk is. And trading is all about understanding your risk. So I'm just trying to cover things at a very high level and just show you what my thinking. But to me, it all starts with a pattern and understanding what the patterns are telling us, and then how to set up our trades once we see that. So I said there were three major patterns that alert me to a major sell-off in the S&P. This is the first one, this double top. And then this is the second. It's kind of a funky trading pattern. I don't think you'll find it in too many common places, but it's called the ascending, broadening triangle, because throughout the pattern, you can see prices are going higher. They start out very narrow, and then they widen or broaden out at the top. And the interesting thing about the ascending broadening, once you understand, once it breaks out, you can pretty much understand where it's going to go to, which is right back to the origin of the pattern. So you can see we're not actually too far away from that. But to me, markets usually overshoot, and they don't just stop on a dime. And I don't think this one will either. So how low can we go? So I think what we're seeing is the emergence of another pattern, which is this kind of like megaphone top. It's kind of like one of these megaphones that you yell out through the coach has from the sidelines. And to my mind, I think we're going to hit the lower end of this thing, which puts us very neatly at about 3,000 on S&P. Now, how we get there is a whole different story. We're at this area of a bit of support. We could break support. We could come back up here. We could roll around and then go down. And I think probably likely that's what's going to happen. So it's very kind of dangerous in here. I mean, today I saw the thing falling. And, I told my members earlier today, don't just chase momentum. And then it was falling. Then all of a sudden in the middle of the day, you had this huge short covering rally. And this is what's been going on. So you can't just fire at these levels. You have to find certain places and what have you. So the way I try and figure out how to join a trade is that I look for what I call my insurance day bars, or just insurance bars. Now, I call these insurance bars because when I see these bars, it tells me where to join the trade and how to ascertain my risk. Now, before I go any further, I should just say that what I'm looking here is a bar chart, right? Most people, I just assume, knows what I'm talking about here. So a bar chart basically shows you the high and the low. In this case, this is a weekly chart. So this is the high and low for the week. So every week or day or 15-minute, whatever time frame you're looking at, you have a range, you have a high, a low, and a close. And what I try and do is see where does this close in relation to the high and low. And you can see this didn't close on the low, but I think we'd all agree that it closed much closer to the low than the high. So by the end of the day, even though this thing went higher, the sellers were in control. So for me, the close is very important. How something closes. Now, you can't just look at these bars in a vacuum, and every reversal say, okay, well, I'm going to go short or long. You have to look at it in context. Well, what is the trend telling you? What is the pattern telling you? And then if you see the emergence of one of these key reversals, then you know how to join that trade. So what I'm talking about is this guy right here. You can see bumped up right up to the upper end of this megaphone, made a new high, and by the end of the week, it closed on the very low, indicating that the sellers were in control. And look what happened after that. All you have to do is see these reversals, and sometimes they point in the direction they want to go. It's actually pretty simple. The market actually points where it wants to go. Here was another reversal, made a new high, closed at the low of the week, and guess what? For 4 weeks later, we went lower. But it was in context with the trend and the pattern. So I have two definitions for these insurance bars. One is the key reversal that I just spoke about, where you either make a new high and close on the low, or make a new low. Look at this reversal. Made a new low, close on the high, and you could have just stayed long that for 2 years and made a boatload off that signal. So sometimes the markets, some bars are more consequential than others. And that's why I look at the big charts, the weekly charts or the monthly charts, because you're not going to see this on a 15-minute chart. So, or I look for the other insurance bar definition of mine is an inside bar. Again, depends if you're looking at a daily, a weekly, a monthly, 15-minute, whatever your time frame is. So an inside bar simply is where the range from high to low is within the range of the previous bar. And to me, I don't really care where the inside bar closes. What it really represents to me is a storing of energy. It's just a coiling. It's a building of energy. And to my mind, the energy was just going to explode in the direction of the trend. So I look at these insurance bars in connection with the previous trend, the pattern, or whatever is indicating where this thing should go. I'm trying to see if I can find, here's kind of a funky inside bar where the explosion was to the downside. So these are my two inside. And then once I size up the trend, the pattern, my insurance day bar, then I have an execution plan that simply says put a sell stop underneath the low. So you can see this thing had a low right here.
Hi, folks, can you hear me at all?
Yes, we can hear you,
Oh,
Duncan.
that's good. I'm just trying to get screen share up till till Mark comes back here. That's good. Let's just try it again here. Aha, we're on. Yeah, I'm sure Mark will be back here shortly. For those of you who don't know me, I'm Duncan. I've been with Mark for over 4 and a bit years here now. I'm one of the coaches on his program, and I like to help out on here to help answer questions, and because he gets so many questions, etc., fired at him. So I just help out on the sidelines here to answer people's questions direct, or just talk about things. If I can't remember exactly what he was just talking about there now, but basically he's trying to show you the basics of the trading and what to look for within the functions of the trading bars and what have you. If I just go on to, I'll share my screen here now and try and just try and carry on a little bit more here till he goes inside bars and reversal bars. Thank you very much there, Greg. Which asset class was he on? Because I only joined it fairly late here. S&P megaphone pattern. Okay, Scott, thank you very much. We'll have a look at that then, shall we? Let's go on to screen share and go on it here. See what happens till he comes back. Right, we are looking at S&P. Let's go to the S&P. Just put it up. Can't be bothered searching for it on my bar. Yes, what he was talking about the megaphone tops on it here, and the reversal bars. I can draw on it here, but I haven't got his drawing patterns. But we get the same drift on it here, as it's been rising for so long here, and over the overall trend has still been down. And although he was talking about the other day having this is what's called an inside day bar. This is a key reversal where it's gone back up, and it's gone back up for the 2 days. It's now hit resistance on the 38 level here, and for the last couple of days, last week, and obviously today's just opened up. Last week it closed right on the low. And for those of you who don't know, who are not used to the bar charts, Mark prefers to use the bar charts as opposed to candle charts because they're far much easier to use. And the reason that being is, you can easily see the horizontal bar on the left is where the day opened, and the right on the right is where it's closed. Or currently is, as the case may be. And the length of this vertical bar is, obviously you can see from what's happened today with the US 500, or the S&P as it's known as, it's opened on this position here. It's dropped down to around the 3588 mark. It's gone up to 3652. It's felt that it hasn't got any more, it means that the sellers are in control here now, and now it's gone back down and it's closed just above today's opening bar. That's what those mean. Key reversals and inside day bars are big points and where what can happen and change within the marketplace. And basically, you as traders have to decide, are they close to support levels and to resistance levels as where you're going to get in and out of the trade. Where a lot of people go wrong, from what I see from talking to many people, is they might see a daily bar or look at smaller time frames, 4 hours, 1 hour, and you can't go trading on 15, 30 minutes and stuff like that, because it's all up and down and it's all nonsense. You can't actually see what the hell is going on. You need to ascertain a trade properly from a daily, a weekly chart to see what's actually going on. And you can see from the weekly chart of the S&P how we had those big rises and everything from here. It's gone all the way down, up and down, up and down. And if you're just looking at here, anyone will just say here that you can see the much better, bigger trend of what's going on. And if you look at the monthly on it, look at the monthly. We are here just below a support level here right now. And what's happened? That was a support level. What's been going up? What's been going down? If this carries on, this is only just, we're only 10 days into the beginning of the month, and it's open lower in the month. And at the moment, it's slightly higher in the month. Now, this, just because there's a spike up here does not mean that we are in for a key reversal or this is going to carry on here. Then this is where you have to ascertain and look at the resistance and support levels where you are going to get in and get out of a trade. Go back to the weekly, and the weekly tells you something different from what the monthly just said. We've opened up this week slightly higher, and now we're currently slightly lower. And then again on the daily, we're still here. And the markets are closed in the States now. I'm in the UK, for everyone who doesn't know that. Yes, Greg, you're quite correct. They are higher. They are more accurate on the higher time frames than what the lower time frames are. The lower time frames are just noise and too much in your head. You just don't know where you are, and you've got to take the spreads into consideration. That's where a lot of people say they're not making any money on the lower time frame trading, because they're not paying attention to what the spreads are. You know, most spreads anywhere from 2 pips right up to 30 plus. You've got to look at each individual asset and contract to what you are. I mean, if we're just looking at this here now, we're looking at hey, don't go speaking from March for more accurate to what I okay. Yeah, look at these pip spreads here. I mean, there's 2 lots on this, but some of the retail programs out there that new people get involved in, there are massive pips, and trading on these smaller time frames means you just cannot even try and make a profit. You've got to go 30, 40 before you even get into profit. Then your time frame's up and you're either in, out, or stopped out of that trade, which is no good for anyone. Would anyone else like to have a look at a specific trade here until Mark comes back? Let's have a look at some shares. Apple. Well, Apple is the granddaddy of them all. This is what's happened to Apple today. You can see Apple opened lower today at the 13. Let's move this out of the way. At the 1380 mark. It shot up all the way to the 1471 mark, then closed back down at the 1450 mark. What that basically means is people took a short on it in pre-market or overnight, the weekend here, and it went down, and the sellers were in control for a period of time. It's hit now a resistance of this level here, which was what, 3, 4, 5 days ago. And it's gone right up, and it's gone right up to what's called the resistance level again, where this was a resistance. That was a spike above the resistance. But as you can see, 3 days ago, that opened up on that resistance. This hasn't got above it again. So what they thought was the buyers were in control, they're not in control. And now the sellers have taken back control of the market. So overall, this is predominantly just telling us that the still overall trend down in this marketplace is still going down. And that's what it is. Oh, hi, Mark, you're back.
I'm sorry, guys. My computer just crashed on me, just out of nowhere. So it took me a lengthy time to obviously, get it back up here. Let me just see. Is everybody kind of still seeing my screen and what have you? Can you hear me?
We're all
Yeah, we
okay
can
here,
see-
Mark.
Yeah, we can see
All
your
back
screen
over
work.
to you, mate.
Okay,
Yeah,
so
it's all-
I was basically done just kind of again, what I really try and do is demonstrate how I, look at all trading instruments from the viewpoint of price. Doesn't matter what that is. I don't care if it's corn or natural gas or the euro yen or, IBM stock. It's all based on price and patterns. And from this picture, you can determine a risk reward scenario. And this is what I do. I'm up, I don't know, over $150,000 on this trade in the New Zealand dollar Canadian that, I sent out to our members over a month ago, demonstrating why I thought it would be good to take this trade. So first off, you'll notice that this is what we call a clean or a naked chart. There are no volume down here. There's no moving averages. There's no Bollinger Bands. There's no MACD. There's no nothing. This is just a clean or naked chart. We call it naked because there's no indicators on this. So I just try and look at price and time. And the markets tell us a story. And so, typically, like I said, I don't like to trade markets like this that go nowhere. But, markets, go up and then they turn and they go the other way. And before they do that, they put on a pattern. And this put on a very pronounced, very, long-term, but if, you just understand symbol chart analysis, you see that the markets went to a new high. They backed off, they retested the high. And when it came back, it put this M top, just like the S&P. Now, here's the challenge, just like the S&P, is that we see this top, the market has top, but, look how long it drove us crazy before it ultimately went in the direction that it indicated. And that is the ultimate challenge of trading. We'll see these signals all the time, and then it's where do you get in, how do you get in, how long to stay. But, the longer a pattern takes to stake itself out, the more, in my opinion, it kind of de-risks itself. It gets to a juncture where at that point, there's literally no risk. I hate to say that, it's kind of reckless. I'm talking over the internet to a lot of people. And, I don't want you guys to run into trouble. But in addition to this double top, you also had this complex head and shoulders. So a head and shoulders price pattern, and I put the strategy workbook there, which includes all these patterns. A head and shoulders looks just like it sounds. You have a left shoulder, a peak, and a right shoulder, and it looks like a man or woman's head and shoulder. And it's all connected by this neckline. And when it penetrates the neckline, it basically indicates that topping pattern. It's a reversal pattern because leading up to that pattern, the market was going up. Then it started chopping around. And then once it breaks the neckline, it goes the other way. And this is effectively what we've had here. You've had a number of shoulders on the left and the right, but basically, this is just a very large head and shoulders price pattern. And it took place over 8 years. 8 years. So really, this thing began in 2013. 8, 9 years. This has been building. And the more this thing goes, once it's ready to go, it's not going to build for 8 years and then be over in 8 days. So, that's why I've just been holding on, because I think we've got months and months of, what could be a huge downward move in the New Zealand dollar, Canadian dollar. Now, once I see the pattern, I look for the insurance bar. In this case, this is a monthly chart where each one of these bars represents 1 month in time. So when you see these bars, they are a little bit more weighty than a 5-minute bar or a 15-minute bar. And you can see that in this month, we went to the high, but by the end of the month, we were sitting right on the low. The sellers were in control. So now you can simply line up your trade where you put a sell stop underneath the low, put a stop loss somewhere out of the way, and then let this thing just run. And so, to my mind, there's really no obstruction. There's no support for this trade until about the 70 price level, which means you still got about 600-700 pips to run to the downside. So these are the trades I look for. Now, do you find them every day, every week, every month? In this case, this thing took 8 freaking years. But if you keep scrounging around in the basement looking for these trades, this is what I look for in my trade. I look for a setup that has maturity, that has all the ingredients that we're going to get a nice, healthy move out of it. Now, we don't do that every day, and I don't look for these trades every day. You can't find something that took 8 years every day. But by and large, this is what I look for. All I need are 1 or 2 of these a year. And these are what make my year. You mess around, you do all kinds of things, but these kind of trades where you just let them cook, this is what makes you money in the markets. So, apologize again for the interruption, but now I'll just take some generalized questions on the methodology. I'm sure you'll ask me to, look at all kinds of charts. That's really not what I want to do here. It's no point in looking at other charts if you don't understand what I did on, the charts we looked at. So it all comes to a shape, a pattern, a trend. And once I understand what this market is telling me, then I try and find ways to join that trade where I can understand what it's telling me, where I can get in, understand the risk and reward. And if I'm wrong, I just go on and go to the next one. And it's not about how many trades you win or lose. This isn't about ego. I can make all my money on this trade and lose on 20 trades and still be a huge winner. So that is a generalized myth. If you see a trading system that's winning 89% of its trades, you have to dig in there and say, well, what is the outcome of that? Are they winning 3 pips on every trade, 5 pips on every trade? And then when they lose, 90 pips and then you get wiped out. So this is just very misleading. What is your win-loss ratio? I could have a win-loss ratio of under 50% and still be a huge winner. So it's all about the quality of your wins versus the quality of your losers. If you cut your losses short, let your profits run, the old adage, that's how you make money. But most people are trading in and out of the market for 7 pips or 10 pips or 15 pips in the FX market. And if you're trading for 15 pips, you got to risk 10 or 15 pips. You got to pay the 3 pip spread to cover that. And so this means you have a 1-to-1 correlation. And you do have to be 90% correct on your trades to overcome the spread and make money. And that's why most people are losing. So what I try and do is have a 3-to-1 risk reward. Meaning, I don't look at a trade unless I can make 150 pips. I don't get in a trade unless I can see visibility to making 150 pips in that trade. And then in exchange, I'll risk 50 pips. So this is a 3-to-1 risk reward ratio. And this means my outcome is far bigger than my losses. If your outcome, if you're just, looking for 7 pips or 10 pips in and out, you don't have a big enough outcome. So you cannot win over the long run. The whole thing is to win over the long run. I could make 10x on this trade and lose, on a whole bunch of other trades. it looks like I've lost 6 out of 7 times. I'm a terrible trader, but I'm up, 300%. So it's not about the number of your winners or the number of your losers. It's your outcome. And most people don't have a big enough outcome. They don't understand the market to see where, a big enough move will be to put them in a position to make the risk reward acceptable. So for me to risk my money, I have to see an outcome that is considerably bigger. When I bought Schlumberger's options at 44 cents, I didn't do that unless I could make 300% of my money. Ugo says, how do you spot them from the myriad of pairs? In terms of FX, I only look at about 15 or 20 pairs. I can go through them very quickly, just down the line, hit them and say, hey, is this a risk or reward? Can I see something here? This is the euro yen. This is the monthly. I mean, that's a big thing. I'll typically look at the weekly. I look at all the time frames. If I'm a little bit confused about something, I'll start with the highest time frame. I'll start with the monthly, then the weekly, then the daily. I'll work backwards. But I look at all of these time frames because I'm just trying to understand from a big picture perspective what is really going on, how to get in sync with the trend or the pattern or the reversal or whatever is going on. And then once I think I understand, then I'll start dialing it back to a time frame where I can understand a risk reward setup. So, I'll go through this over the next, we'll keep on taking a look at the trades, but it all comes back really to the same principles. Is the market going up or down? Or is it reversing? Or is it sideways? Is there a pattern? Once I see a pattern, then I look for, my key reversal bars. So I'm quickly looking at this euro yen and, it's starting to, so it's been going up, but it's stalling out up here. Right? Every time it pushes this at this 145, it's kind of stalling out. Now, it's also got, whoa. So, I'm kind of looking at these guys right here. You have these 2 reversals right there, but you still have an uptrend. So, I haven't done anything yet, but, we're kind of stalling out at this 145 price area. And when things stall out, they can go the other way, but I'm not really looking at any trades there. So I can look at these trades very, very quickly and size them up. I told our members yesterday to short the Australian dollar versus the US dollar, because you had this reversal in this downtrend. So here's an example where you see the pattern in the Australian dollar all the way here. You can kind of see this double top, head and shoulders here. You kind of see another double top right there. And this is a downtrend. So you can see once it kind of cracked this neckline, like New Zealand Canadian, it was like the gun is fired. And now it looks like you could come and retest these COVID lows. There's no support in here till 54. So, markets grab a hold and they do certain things. But for right now, there's no discernible support. This is just in a free fall. So, I can look at these markets very quickly. And then once I see that we're in a downtrend, now I try and figure out, okay, where are the bars that I can see the risk reward? Here's a reversal here. Made a new high, close on the low. All you have to do is put your sell stop there and you're in a good trade. Now, as it gets going, it's a little bit more dangerous. Here's another reversal. And I said, put a sell stop here. But, as you get lower and lower, you now start introducing the possibility, you get these short covering rallies. So it really depends where you are in a trade. Obviously, this reversal up here and getting in here is a whole different story than getting in here. But it still looks like this trend is still game on. So the risk reward becomes very, very different down here than it was there. Then you got to have a make calculation. Do you want to get in that trade? So that's basically it. Is it a good idea to trade in a free fall situation? Well, when something is in motion, it tends to stay in motion. But, you introduce the possibility that, you've had a tremendous fall away. So this thing's dropped from 72 to 62. This thing's dropped 1,000 pips, really without a hitch. So now you have to make it's a whole different calculus getting in there than there. But, it still feels like there is a lot left on the table. And once these things get going, they can just pick up steam. So you might as well get positioned in there. So, you have to determine the risk reward. But frankly, I think that this is still going to go directionally. Every trade is different. You can't just make a uniform, judgment on that. But this whole thing is a double top, head and shoulders. This thing, like the New Zealand dollar Canadian, has been building for a long time. So once you've been building, this is a distribution. This is where people have been getting out, selling. So once you've had 8 years of selling on top of here, it typically doesn't just, give up without a, even if you have this thing, you have to sell into that. So the risk reward calculus is, a little bit different as it gets going, but then you have to make a judgment based on what, you're looking at on the chart and where do you think this thing can go. And I think there's just a lot of room. This thing can, can it go here before it goes there? Can it go there before it goes there? So it can do a lot of things before it gets here, but this thing looks like it's going to be in a free fall. And so I'm short. That's all I can tell you. Are there any questions before I wrap up for the day? And I'm sorry about the technical glitch there. But, come back tomorrow at 4:30 Eastern time. I'll kind of give you a link to my book that kind of explains this 4-step trading process in much better detail. Am I still in Moderna trade? I'm not in right now, Ray, but it is a good trade. It is a good idea to be short. This thing is going to go much lower. So I've been telling our members that, you should, be short this stock. It's kind of dropped since 198 to 120, but we're at this level here around 120. You can see that there's just a lot of support. So to my mind, I will short the rallies because this will be a $60, $50, $40 stock. And again, my prediction is solely based on an observable, quantifiable price pattern. Here is just a large double top sitting on top of a huge head and shoulders price pattern. And to me, it's not a question of if, but when this thing is going to kick through the door. And so you could just put a pending order there at, $110 or $100. And when it kicks through here, it's got nothing in its way. So people are asking about our different programs. I appreciate that. If you have any questions, just give our support team, support at the Pattern Trader, a call. After this 3-day webinar series, you'll get a link from our team inviting you to take a look at our programs, and you can kind of check it out from there. But if you're interested in getting in front of the line, just give a holler to our support team at support@thepatterntrader.com. But I appreciate you asking, Happy. So I'm going to leave it there. I'll kind of just answer 1 or 2 questions about the trading methodology itself. Do you guys understand the patterns and the price action that I was talking about? I know I go quickly and maybe I assume too much. But again, if you just stand back and understand, if you just look at the market points and tells us where it wants to go. So you can see here at the very, very high at Moderna, it made an all-time new high. So when you saw the news later in the night to say, well, Moderna made a new high. Well, but how did it end? You can see that by the end of the week, it closed on the low and the sellers were in control. So actually it told you right there that it was over, that this thing was just going to go lower. So that was when it was at $400 and now we're at 100. So price actually points. And then you can see there were a couple of other, double top right here. And then the price pattern, you can see it made a new high, close on the low, made a new high, close on the low. So all of these guys are pointing. The market points in the direction it wants to go. Happy says the method needs a lot of self-discipline and practice. Well, everything is, trading is not easy. If everybody could make money, they would. But, everything is discipline and commitment, but it all starts off with certain basic principles. And to me, the first thing is do not hang out in forums. Do not listen to what other people have to say. I have a saying, the market is always right. I can be 50% right, whatever. The market is always right. The market is always going to go where it's supposed to go. And before it does that, it usually points the direction. So that the discipline is to follow the market. But this is not what most people are capable of doing. Where it's very hard not to watch the crawl or what Powell says, or, watch our, positions go up and down. The worst thing you can do is watch your positions. The worst thing you can do is watch your money balances go up and down. The whole thing about this game, I'll drill it down to one word. You have to be objective. Unemotional. No ego. Not picking sides. You have to surrender to the will of the market. And this is where most people go wrong. They have an opinion where gold's going to go. Why? Because inflation's up, or, Russia invades Ukraine, so gold's got to go up. That's how most people trade. They see these things, they have an emotional attachment, they see the prices go, they want to join it, they jump in the fray, and then it's up their ass and they wonder what happened. Because you're not objective. You simply have to be looking at what prices are telling us. Now, prices get to certain levels. So this market tells us it's going down, but price gets to certain levels and those levels don't give way very easily. So it's just understanding a lot of the nuance of the market, but in the main, this is telling me that this stock is just going to be destroyed. This thing will be below $50. So if you have the patience, you don't have to worry about where it is now. It's 123, this week, and 135 next week, even better. Get short, because there is no doubt in my mind that that's where we will be. So, what most people will do is just, get all turned around by these counter trend trades that shake the leaves and shake you out. And then you wonder how this thing ended up at $50 and you weren't in. Neelan says, this is a good question, and I take a lot for granted. I'm sorry for that, and Neelan, thank you for reminding me. So there are certain mechanics in shorting a stock. If I want to short the euro yen, I just hit a sell button versus a buy button, and it's no problem. You just execute the trade. But in order to take advantage of a down move in a stock, you have to go short. Now, this mechanics are executed by your broker. But the way it works is that you need to borrow the stock by somebody else who owns the stock. So somebody who's long the stock, they're going to be long forever. They're not doing anything with it. I come along and say, hey, can I borrow your stock? And they go, sure, I'll lend it to you for a fee. So they lend it to me, and I short it. And then if it goes down, I buy it back and I cover. I have to buy it back in order to cover. Now, I don't want to get you too lot. The broker does this for you. The broker goes and finds where the stock is and they loan it to you for a fee. And then you go short. And it just simply means you're, selling rather than buying. You're looking to take advantage of a decline. The big problem is when you get into a short squeeze, where you short the stock down there at 100, and now it's up there. So the problem with being short is that, if you buy a $15 stock, all you can lose is $15. It can only go to zero. The problem with being short a stock is that you could have unlimited risk. There was a hedge fund that just went out of business this week because they shorted GameStop. They were short at $5, thinking this stock was going to go out of business, which it should have. And they were short down here at $5 and it went to $500. So you can understand how this could create a little bit of stress. So this is the problem. This is what you can run into. So you have to know what you're doing. So is it better to short a stock or buy a put option? Well, that depends. So the problem again with, being short is that, and this is what happened, and you had a whole bunch of hedge funds short here at $4. And then, they had to scramble to get out, and then they were wiped out. $10 billion was lost on the stupid thing that had to come back down to zero, and that's where it's coming back down. But in the meantime, you get these margin calls and you're fried. So this is what can happen. You get short here and you get these squeezes. This is the problem. So to your question, Neelan, if you buy a put option, you can only lose what, you pay for that put option. So the problem with buying options is that you can lose 100% of your bet. That's the bad part. The good part is you can only lose whatever you put in. So you put in $300, you lose $300. You don't lose, your life. So these are the risk reward calculations you have to make. So I'm going to end it there. I'll be back tomorrow, 4:30 Eastern time. Hey, John, good to see you. Neelan, you're welcome. I'll be back 4:30. But it all comes down to being objective about analyzing price. And it doesn't matter what your game is. Google, gold, the pound yen. I look at everything the same. What is the trend? What is the pattern? And then what is my risk versus my reward? And if you can make the case for, a good risk reward, the bigger the reward, the bigger the outcome, the better the trade. And I think most people are trading too short term for too small an expectancy, too small an outcome. If you're trying to get 7 pips on some magic moving average crossover, and Bollinger Band thing on some 15-minute EA, you're eventually just going to get wiped out. And then what happens is you lose your objectivity. So you win. Your mind turns into mush, and then you get wiped out. The whole thing about this game is not being caught out, not being, hit on one of these trades. So you have to be objective. You have to, trade less. So my thing is I'm looking at these bigger time frames because I'm trying to be a part of the bigger trades that take place over time. If you're trying to get in and out every 5 minutes, 7 times a day, it's just not sustainable. So it really depends what you're looking to, get out of your training. And I am looking for the big moves in the markets. They don't always come. And so, it's just like everything else. It's patience, it's discipline. And you don't need too many of them. You catch one of these monster moves and you make your year with one trade. Thank you very much. Thanks, Eduardo, as always. Thank you, Dee, and greetings from Sydney. I have a lot of people that I know there. I don't sound like it, but I'm an ex-South African, and I probably know more people in Sydney than I know anywhere in the world. So you're in a good place. And I hope you don't get flooded out this summer. Thanks, son. Thanks, Sebastian. Thanks, Dee. We'll see you tomorrow. Thank you, Dwight. Sorry about the glitch. We'll see you all tomorrow.